Hi, Gigi from the RBA. This video talks about asset prices and interest rates and is an accompaniment to one of our videos on monetary policy transmission. In that video on monetary policy transmission, we discussed how monetary policy can influence aggregate demand through the asset prices and wealth channel. This is because asset prices and the wealth held by households and businesses affects how easily they can borrow money and also how confident they are to spend it. In general, lower interest rates tend to support higher prices for some assets. One reason for this is because lower interest rates increase the future benefit provided by these assets relative to before. So let's unpack this. First, we need to know more about how assets are priced. Recall from our video on short and longer term interest rates that an asset is something valuable. It's valuable because it provides a future benefit to its owner. Most assets have a market price, the price a buyer can purchase the asset for today. To guide the market price, buyers and sellers of assets will estimate the future benefit in monetary terms that they expect the asset to provide. For example, for a house, this could be the future rental income, minus the cost of maintaining the house, and also what they think they can sell the house for later on. Next, they need to combine all of these future benefits to figure out the overall value of the asset. However, they can't just add these sums of money together because they're received at different points in time. In fact, when someone receives money, now or in the future, can be just as important as how much money they receive. In other words, money has a time value and a quantity value. For example, suppose you receive $100 today and will receive $100 more in 1 year's time. Say you deposit today's $100 in the bank and will earn $2 interest on it over the coming year. This means in a year's time, the total value of your deposit will be $102 and the simple interest rate you receive is 2% per year. A short way to do this is to multiply today's $100 by 1 plus the interest rate of 2%. But when you receive the next payment in a year's time, you'll still only get $100. So a year from now, today's $100 is actually worth more to you than the money you will receive then. This example shows that measuring the value of an asset today must account for both the time and quantity value of money. To do this, buyers and sellers will discount the future benefits they expect from an asset so that they have the same time value as if they were received today. They can then add these amounts together and use this to guide their assessment of the market price of an asset. In our example from before, this would involve working out how much money you would need today so that you had $100 in a year's time, the opposite to what we just discussed earlier. So, in contrast to how you multiplied before, instead, you now divide the $100 expected in a year's time by 1 plus the interest rate. This means the value today of receiving $100 today and $100 in a year's time with a 2% interest rate is about $198. Why have we discussed all this? Well, notice in our example that we measured the difference in the value of the money over time as an interest rate, which reflected the opportunity cost of receiving the $100 in 1 year's time versus today. If this interest rate falls, then the opportunity cost of receiving a benefit like money in the future relative to today also falls. For an asset, this increases the value of its future benefit, and so its market price will also increase. See if you can work out the value of the $200 payments from our example if the simple interest rate were to fall to 1%. That's all we're going to cover in this video. See you next time.